Hey everyone, it's Ed Kime and welcome back to the Quantcha Challenge. Today is Friday, January 11th, and we're going to take a look at our current portfolio right now to get a feel for how we're performing. Um, we opened up a covered call on Microsoft a couple days ago. Unfortunately for us, Microsoft has kind of been dropping since then, but that's okay. I mean, even though this call was struck for the short term, we are kind of have more of a long-term bullish outlook on the stock, so we don't mind taking a little bit of a hit now. From our perspective, we just sort of lowered our cost basis. One of the things I've been looking at is potentially rolling this call because we've gained more than half the potential profit from it, and since it does expire next week, there's a case to be made to go and roll that down a little bit, see if we can squeeze out a little more profit from it and hedge against a further drop. Now, yesterday we opened up a bullish spread on Carnival and a bearish spread on Exxon, and the goal there was to start to play some views, some directional views that we have, and also to take those positions and start to build out something that would build us in a direction towards being more beta neutral. And in this case, you can see the S&P dropped today. It's down a little bit. Our overall portfolio is actually it's down a bit because of this drop in Microsoft, but we're doing pretty well on our directional trades. Even though they're showing with the market pricing a loss of $30 and $52 respectively, we would probably be able to get out a little better than that because the pricing is moving. We were using the market pricing, so if we were to try to exit at midpoint, I think we'd have a good shot of doing a little bit better on our exits. So I think in this case, for example, we could probably turn a profit on both these trades if we were to close them right now. But we're going to hold on a little bit longer. Today being a Friday, I like on Fridays to sort of review where things are with a portfolio. Now, our goal for January is to gain 1%. We started right around 26,000, so our goal is to get to 2,600. I'm sorry, $26,260, let's say. So the goal is to make that. Right now, we're down a little bit below where we started, primarily due to liquidity and this Microsoft drop. But I feel really good about the direction things are taking. Carnival slightly moving in our direction. Exxon also slightly moving a little better in our direction. Things are looking good. But when I take a look at our Greeks here, the big number that worries me is that we've got this significantly positive delta relative to our portfolio, which means that we want to keep this beta weighted delta as close to zero as possible because we really don't want to be at the mercy of what the market's going to do. Now, we're making these directional trades with the expectation that the directional trades are going to go in the direction we want. But the main risk you have is that, as we saw a couple months ago, when the market itself starts to tank, when it goes from drops 10% or what have you, everything drops. That's a pretty universal rule. And so the reason we want to get to this beta weighted zero for our delta is just to say that that means that we have a fairly even number of benefits for the downside that we do for the upside. And even though a big move into the market in either direction will probably hurt us a bit, it won't hurt us nearly as much as if we were bullish on everything or bearish on everything and everything was positively correlated to the market. So a lot of times what people do is they'll go out and they'll take the S&P or they'll take some kind of index and you can short it or you can buy puts or sell calls or do whatever. In our case, what I'd like to do is I'd like to find a trade where we can trade in about that $500 budget that we've been looking at and see if we can't make up for this 37 beta weighted delta that we are currently long. And I have some ideas for some stocks, but I figured let's take a look at our stock screener. And we've got a stock screener here. If you go to the screeners tab, we've got some save screens up here, but we've got, in addition to a stock screener, we've got a bunch of trade screeners. And the way things are designed is that our stock screener has a bunch of fundamental and performance and option implied metrics related to it that you can filter down to stocks. And then the trade screeners take the stock screener and extend it with specific things for trades. So a lot of times it's good to just start here. Even if you kind of have an idea of what trades you want to make, you can kind of start in the stock screener, as we'll do here, and go then and then take whatever your results are here, and then you can pass them into a specific trade screener, and it'll default you to these settings that you set up here, and then you'll have all that. You can filter down the kind of trades you want if you're looking for deltas, if you're looking for other stuff. Now, the default setting that I've already reset the settings for the filters and so on. So right now we're just sorting by symbol, and this is pretty much all of our stocks. Now, the specific thing that I wanted to look for is I'd like to look for some way to get some negative beta, um, or negative beta weighted delta. And so what I'm going to do is I'm going to take a look at a short-term momentum play. So I want to sort by, in this case, we'll sort by the equity change, and it's increasing, which means that these are the worst performers on the day, and it moves upwards. And we see a lot of these red drops, which means that those options have no liquidity, or the yellow drops, which means they have poor or fair liquidity. We'll probably avoid those since we're looking at a short-term play here. So I'm going to come down and I'm just going to tell the liquidity rating that we want at least good. Now that filters out a bunch of stuff here. Um, and you can see that these are the stocks that we're looking at. They have at least a rating that is great liquidity or good liquidity. And the stock that stands out immediately to me is Starbucks. This is actually probably going to be what we move with here because I know that they're kind of impacted by China right now, the U.S.-China relations, and they're moving down with earnings coming up. It looks like next Friday, or actually 2 weeks out. And so because of that, yeah, we got the 10 trading days here. Because the earnings is that far out, we can make a trade really over the next week that'll help us get some nice negative beta towards our portfolio. And so yeah, if we move with Starbucks, we can see from the trade drop down all the different expirations here. I mean, we know that. Let's just take a look at the 18th, which is next Friday, and we'll use next Friday as as our target here. And by default, we've got a bunch of trades here. We're going to go with a range preset that is moderately bearish and apply that and see what we're looking at trade-wise. So we could take on a moderately bearish trade here. It's still using some of the settings we had from yesterday, like the minimum return is at 0. So for this bearish view, this -1 volatility drop all the way up to no change, for that particular view, we're not going to see any trades right now that don't at least turn some profit for the entire duration of that trade, or rather the entire range that we're price modeling for. I'm going to notch it up to use all the options that are available right now, or at least the 100 best ones, and see if I can find a trade. Now, the average returns on these are really good. Some of these, the potential is actually close to doubling, which is pretty good. I don't. The reason I'm looking to get bearish on it is because the stock's under a little bit of trouble, and it's also moving into earnings. And because it's moving into earnings, I don't know if there's going to be a ton of play on it, but the question is, if we see the market drop over this period of time, do we expect a stock with the kind of pressure Starbucks is facing to go up? And frankly, I don't. I think that if the market continues to drop or continues to stay where it's at, Starbucks will probably naturally gravitate a little bit lower. Now, one of the other benefits to Starbucks is that it is a Seattle area company, which is a good counter to our Microsoft holdings, which is also another Seattle area company. And I don't generally like to bet against Seattle, but in this case, we're doing it for the purposes of hedging, so it's all right. You'll also notice that put call parity means that these two trades are pretty much identical. So we kind of have that interesting thing, a bear put spread or a bear call spread with those same options. Um, I'm just going to go with the first trade. I prefer if we can ideally go for the credit trade here, so that if it moves in our direction, we can get some just expiration and not have to worry about closing it out later on, or the exercise or anything. We do see a bit of a negative return here. If I take a look at the details, the liquidity is pretty good for the options. So that's just, we're taking a bit of risk here going for this trade. I guess that's some of the necessary thing. I mean, it's under the $500 mark. Let's model it in our book because I would like to see how entering a trade like this would impact our portfolio. We can see it is likely to be a gain for us, but the mean return is slightly negative. If we were to enter this trade, oh, this is actually really good. So we get a bunch of negative beta. We have nothing on the book right now because we don't have any Starbucks positions. So we would get about -200 Starbucks delta. But the correlation means that that would map to about a $33 drop in the event that the S&P went up. So we get about 33 beta weighted delta, which means that when we add it to our current 37, we're looking at a new beta weighted delta of about 5. So which means that in the event that the market moves up or down $1, it should only impact the overall portfolio by about $5. Now, of course, that's just based on the best information we have available. Who knows what would exactly happen? But this is a pretty good measurement that would help us feel like we are managing our portfolio pretty well. And that's also using the market pricing. So I'm going to go to the track changes tab here, which is the trade we were looking at, and I'm going to go ahead and see if we can enter that trade. One thing I don't like is obviously this is super close, this 63 to 63 and a half, which means that if we get toward expiration, and we're planning to hold this pretty much through expiration, if we get there and it's not significantly on one side or the other, we're going to have to close it out, which means we'll take a liquidity hit at the end there. For now, I'm just going to preview the order, see if we can get in at 24. And I'm looking at the debit here. That's a mistake here. We shouldn't be dealing with this. Oh, we actually looks like I made a bit of a mistake here, and I selected the debit trade. I would really prefer for us to have a credit trade, as I mentioned. So we were at the bear put spread. I'm going to keep backing up until we get back out to the search results. I pointed out earlier we had, because of put call parity, that buying the put spread or selling the call spread were pretty much getting us the same exact returns. So I'm just going to select it here. I'm going to go to the trade ticket. I'm just going to fire this right off to the trade ticket here, see if we can't get a good deal, see if we can get ourselves 26 cents. You know what, we'll try to notch it up a little bit and see if we can't get 28 cents. I don't expect to, but we'll see. We're just trying to keep our risk here under 500 and give us that short-term beta-weighted delta. This way we can protect ourselves from a downside movement in the market. Ideally, the market's going to kind of stay in the general range it's at now, and then over the run of the next coming days and months, what we'll see is that our directional views will take hold and we'll make profit off of those. They're not all going to be profitable, but at least if we manage the trades correctly, we'll be able to get the profit we can, and the winners should outpace the losers, and we won't be hurt too bad in the event that the market takes a big move on us. As they say, all correlations, in times of extreme movement, all correlations move to one. So everybody kind of heads towards the market. So our net credits at 28, we can see that the midpoint's already at 27. I will see if I can, I guess we'll just kind of notch it in a little bit here, see if we can't chase that down and get to that 27 cents. I'll give it about 5, 4, 3, 2, 1. All right, now I'll go to 26. I see it's moving around for us a little bit. Hopefully, we'll land somewhere between 26 and 27. I think that'd be a pretty good credit on a 50-cent spread. And we'll let that stew for a moment. Take a look at our portfolio again. Now, I talked a bit about potentially rolling out these Microsoft options, and this is something that, because there's a week left and we are actively managing it. I mean, generally with covered calls, you want to go 45 days out, like 30 to 60 days out. You'll get your highest theta. So, for example, if we go to Microsoft, we'll take a look at the charts, and we've got a good one here is the implied volatility by the strike. So we're looking at, let's see here. We're going to remove that. We're going to grab our next week's, and we're going to take a look at the call smoothed, or actually we'll look at the mean smoothed. We'll spread this out, and let's switch over to theta. I think theta by strike would give us a better view of what we're trying to illustrate here. So if we come in to about here, we can see that we're looking at, this is the theta for next week. We can see there's a bunch of theta near the money, and if we go to, or rather this is this week, if we come out here, we're going to add for next week. We'll get rid of this week. This is going to help us too much. So this is the theta we're looking at for that. And I'm going to add let's say go out to about February. And we can see that it's a bit lower here. Yep, trying to zero in on this, a little unwieldy. So we've got our January, and you can see the theta at the money is higher, because there is a lot more movement that's going to come in. So the amount of money that's being lost for an option that you're holding long is going to move very quickly around this point. And as you get further out, theta is going to be lower, but there is an optimal point. If we go out to March here, what you're going to see is that the difference between these tends to get lower and lower. Now, one of the reasons you don't want to necessarily go for the short-term ones is a lot of times the risk is not worth it. As we saw, like, we opened a covered call a couple days ago, and the theta that we're burning off on that is great, but we're also losing a bunch on the short-term movement of the stock. The further you go out, the more time you have for the stock to move in the direction and play out the view you have, which in our case is bullish. So if we go, we're looking at the Januaries for next week, we got the Februaries, we got the Marches. If we go out to April, we add those calls, you see it's going to be lower, but you see, notice the difference, the distance between these is much lower. And so if you want the biggest bang for your buck, the shortest term is the best, but it also comes with the highest risk. Now, if you're super confident, you say, hey, I don't think this stock's going to move much for the next 6 months, you can go out here and still make some good money off of the theta from the Julys, and that's great. But as you can see, the difference in the prices here, if you take a look at the specific details, you get diminishing returns the further out you go. And so that sort of that magical, or that preferred point for a lot of people is to be about, when you look at the amount of money that you're going to get back versus the risk you're taking on in order to figure out that great return, it really is about 30 to 65 days. But I'm not really sure we're going to mess around too much with that. Let's take a look, see if check back in on our orders. So we got that Starbucks order, 26 cents. Yeah, I don't really want to go below 25 cents. I'd like to at least make half the spread on this. But the problem with the pricing, when the pricing moves away from us, so 25 is not so bad. When the pricing moves away from us, you set a spread, you ask for $1, you ask for whatever. As it moves away, that usually means that your view is right and you didn't get in quickly enough. So when they offer you less money to take on the risk, it means that there's less risk there in the eyes of the market. So it's a good and a bad thing. I mean, the worst thing is if the current offer, the current request for a trade is about $1 and you ask for $2, that means that the risk that you're asking to take on there, you're not going to take on that trade. Nobody's going to give it to you until the risk meets the pricing you're looking for. And so anyway, we'll probably sum it up here. One quick thing we'll do for our Friday review is we talked about all the trades. Starbucks is our new one. We're going to be a little bit bearish on it. I think that hopefully we'll see this move in our direction. Now, it is a call spread. We don't have any, it is a little bit in the money here for the ones we're short, but I'm not too worried because they don't have a dividend between now and the expiration next Friday. And in addition to not having a dividend, they also don't have there's really nothing that I anticipate happening to make the value of owning the stock more than the time value of the option. So as a result, I think we'll kind of hang out. Unfortunately, it looks like they're catching a bit of a bid at the end of day Friday, but that's some of the risk we take on. We'll take a look real quick at our Greeks, and we can see that because of some of the movement, the market, I guess, is moving around. We're looking at a 15 beta weighted delta right now, which isn't so bad. It's better to be smaller because we don't want that market exposure. And so we'll probably just leave it here for now. I had considered moving this call around. I don't think we're going to do that today. Although there isn't that much, there's only $45 sitting on the table for us. So if we do take a quick look, just to see what happens if we roll that down. So the stock's at 102 and a quarter right now. So if we roll this down, and let's say we kept it, we'll keep it at next week, and if we rolled it to 103, we can see what we're looking at from a difference. Now, of course, we're giving up a lot of our upside potential. And I think this upside is very achievable. I mean, this is the one volatility line, so there's still a substantial possibility it could go all the way up. I mean, there's a lot further up it can go, but the point is, I usually, if we were outside, if this inflection point were out here, I definitely want to bring it in so it was within that one volatility mark, somewhere in this neighborhood, maybe closer, just to get the extra theta. But for now, if we were to roll down, what we'd be doing is we'd be giving up a ton of upside, and we'd only be protecting ourselves on the downside by a little bit. I mean, the net change in the book value, we'd be collecting $74 in net credit change. I don't know that that's worth it at this time. We'd be locking in the gains from the call itself, but again, we're not really worried, frankly, about the value of the call that we're currently short. We're not worried about that call increasing in value because it would only go up in value if the stock went up in value. So we'll just kind of leave that where it's at. So we're not going to make a move here. We'll just kind of hope that the market uh, will sort of shake out in our direction, and let's hope that we don't get bitten by this Starbucks trade. I mean, wow, that's already moving pretty hard against us. The liquidity is not too bad either, so that's definitely just a jump in the pricing we were working with. But again, it's 22 cents over the strike price we're hoping it drops below next week. And like I said, if we are convinced and we're bearish on it in the short term, shouldn't be a problem. So I'm going to wrap it up here for Friday. Hopefully everybody has been able to follow along pretty easily. As always, if you have any questions, please leave a comment below or hit us up at hello@quantcha.com. And as always, good luck and good hunting.